Okay, Chapter 11, reporting and analyzing equity. So I'm feeling a little bit under the weather and have a terrible cough here, so I'm hoping to be able to get through this without too much interruption, but we'll see how it goes. All right, so identifying the characteristics of corporations and their organization. All right, so a corporation is an entity that's created by law and is separate from its owners. So one of the accounting assumptions that we had talked about in Chapter 1 was that the activities of an organization can be tracked separately from that of its owners. So it has most of the rights and privileges granted to individuals. So the owners of corporations are typically called stockholders or shareholders, and they can be separated into two types. So you have privately held or closely held corporations, and they do not offer stock or they do not offer stock for public sale, and they usually have very few stockholders. And then a public corporation has stock available for sale, and they have oftentimes thousands of stockholders. So public sale usually refers to the issuance of stock, like on a trading stock and trading on a market. Okay. All right. So corporations represent an important type of organization. So their unique characteristics have disadvantages and advantages listed here. So advantages is that they're a separate legal entity. They have limited liability. You can transfer ownership rights. They have or are presumed to have a continuous life. Uh, there's no mutual agency for stockholders, easy capital accumulation, and then some of the disadvantages are they're subject to governmental regulation and corporate taxation. So corporations created by obtaining a charter from the state, and then they organize the organization expenses or the cost to organize the corporation typically include legal fees, promoter fees, amounts paid to obtain the corporate charter. The ultimate control of a corporation rests with the stockholders, who usually vote in a board of directors or elect a board of directors. And then in turn, the members of the board will hire the executive officers of the corporation. And then the executive officers hire the employees. So stockholders have specific rights under a corporation's charter and general rights under state law listed here. So they can typically vote at stockholder meetings or they can register by proxy. They sell stock. They can purchase additional shares of stock. They can receive dividends if they're declared. And then they share in any assets remaining after creditors are paid in a liquidation. So here's an example of a stock certificate. I actually don't know if they send these anymore. But back in the day, they used to send actual stock certificates. So each unit of ownership is called a share of stock, and the certificate serves as proof that the stockholder has purchased the shares. So basics of capital stock. So typically on your financial statement, you'll see under the stockholder equity section, you'll see common stock that'll state the par value. It'll tell you how many shares are authorized and then how many of those authorized shares are issued and outstanding. So the issued and outstanding amount is the amount that's been sold or issued to stockholders. The amount authorized is just the total amount of stock that the charter authorized the corporation to sell. So par value versus market price. So par value is just an arbitrary amount that's assigned to a share of stock when it's authorized. The market price is the amount that it'll actually sell for on the market. And you can have par value, no par value, or stated value stock. So corporation's equity is also known as shareholders' equity or corporate equity, and it consists of paid-in capital, which is the cash and other assets that organization receives in exchange for stock. And then retained earnings, we've talked about this before, is the accumulation of the net income or net loss of the organization over its entire life, net of any dividends that have been distributed. Okay. Excuse me. So recording the issuance of corporate stock. So let's say that on June 5th, Dylan Snowboards issues 30,000 shares of $10 par value stock for $12 per share. To record that transaction, we're going to get, we sold it for $12 a share, so 30,000 times $12 a share. We're going to receive $360,000 of cash, so we'll debit cash for $360,000. The common stock account is always credited for the par value, and then anything in excess of par goes to this account we called paid in capital in excess of par. So the $10 per share times 30,000 shares is where we get the common stock credit of 300,000. And then the difference between the $10 that you sold it for and the $12 you sold it for and the $10 par value, $2 per share times 30,000 is what we credit to paid in capital in excess of par. Okay? And so if we were to look at what our stockholder equity section of our balance sheet looks like after that transaction, you would have your stockholder equity section, you'd have your common stock account with your key characteristics in the description, so your par value, how many shares are authorized, and how many shares are issued and outstanding. You have your 300,000 common stock, you have your 60,000 paid in capital in excess of par, and then retained earnings for a total stockholder equity of $425,000. All right, so that first example was what do we do when we have par value stock? Well, in this case, let's say we issue no par value stock. So Dylan Snowboards issues 1,000 shares of no par value stock for $40 per share. So if there's no par value, the entire amount gets recorded to common stock. So you just debit cash and credit common stock for the $40,000. All right, what if we issue stated value stock? Same thing. On June 5th, Dylan Snowboards issued 1,000 shares of $40 stated value stock for $50 per share. So you're going to take your $50 per share that you sell it for times your 1,000 shares. It's going to be your debit to cash for $50,000. Your common stock is going to get credited for the stated value. So that's your $40 per share times your 1,000 shares. And then you have paid in capital in excess of stated value for common stock, which would be your $10 per share times your 1,000 shares. So it's different words, stated versus par, but same exact idea. Okay? All right, well, what happens when we issue stock for non-cash assets? So let's say on June 10th, 4,000 shares of $20 par value stock was exchanged for land. So we're going to get land valued at 105,000. So we're going to debit land. They tell us what the par value is, so we know what our common stock entry needs to be. It's our 4,000 shares times our $20 par per share. So that's $80,000 that we're going to credit to our common stock account. And then the difference, or the plug, in order to make our debits equal our credits, is going to go to paid in capital in excess of par. And so that's the $25,000 that you need to make your debits and credits balance. Okay. All right, so let's look at an example. So prepare the journal entries for the following 4 separate issuances of stock. So a corporation issued 80 shares of $5 par value common stock for $700 cash. So we know we're going to have a debit to cash for $700. They tell us the par value, so what's going to get credited to common stock is our 80 shares times our $5 par. Well, 80 times 5 is 400. So the plug to make your debits equal your credits is going to be a credit to paid in capital in excess of par for 300. Okay, your transaction or your credit that gets booked to common stock every time needs to be for par value. And then anything in excess of that goes to paid in capital in excess of par. Okay? All right, so if the corporation issued 40 shares of no par value stock to its promoters, estimated to be worth $800, and it has $1 per share stated value. So they're issuing the stock basically in exchange for the expenses. So you're going to have a debit of $800 to organization expenses. They tell you that it has a stated value of $1. So you're going to take 40 shares times $1, and that's going to be your credit to common stock, and then the difference goes to your paid-in capital as a credit. And number 3, the corporation issued 40 shares of no par value common stock in exchange for land estimated to be worth $800. The stock has no stated value. So you just have land, debit 800, and credit common stock, no par value for 800. Okay? Then number 4, the corporation issued 20 shares of $30 par value preferred stock for $900 cash. Well, we're going to have a debit to cash for $900. They tell us that there's 20 shares of $30 par value preferred stock. So you're going to credit preferred stock $30 par value equal to 20 times 30, 20 shares, $30 par, that's $600. And then the difference goes to your paid-in capital. Okay? All right, so let's talk about recording transactions that involve dividends and stock splits. So cash dividend is a way to provide return to investors. And so to pay a cash dividend, 2 things must be in place. You must have sufficient balance in retained earnings, and you must have the cash necessary to pay it. So when we account for cash dividends, there's 3 important dates. There's the date of declaration, date of record, and date of payment. The date of declaration is the day that we record the liability for the cash that's ultimately going to go out the door to our stockholders. The date of record, there's no entry required, but you have to be a stockholder on that day in order to receive the dividend. And then the payment date, so that's the actual date that the cash is going to leave the company. Okay? All right, so let's look at an example. So on January 9th, $1 per share cash dividends declared on Zetec's 5,000 common shares outstanding. So the dividend will be paid on February 1st to stockholders of record on January 22nd. So if we pay $1 cash dividend, we're going to reduce our retained earnings by $5,000. That's dollar times 5,000 shares. And we're going to increase our common dividend payable by $5,000. So that's going to be the liability that we record at the date of declaration. Then when we pay it, we're going to reduce our common dividend payable with a debit of $5,000, and we're going to reduce our cash with a credit of $5,000. Okay? All right, so a corporation with a debit or an abnormal balance in retained earnings. Remember, retained earnings has a normal balance of a credit. So a corporation that has a debit balance or an abnormal balance has what we call a retained earnings deficit, and that normally occurs when the cumulative losses and or they pay more dividends than total earnings from a current and prior years. So the deficit is reported as a reduction on the balance sheet. So this is an example of a retained earnings section of your balance sheet or a stockholder equity section of your balance sheet. So they have common stock at $50,000, but they have a retained earnings deficit. So their total stockholders equity is only $44,000. All right, so let's talk about stock dividends. So stock dividends, they're declared by a corporation's directors, and they're basically a distribution of additional shares of the corporation's own stock to its stockholders without the receipt of any payment or return. So stock dividends and cash dividends are different. So stock dividends don't reduce the assets and equity, but instead they just transfer a portion of equity from retained earnings to contributed capital. And so why would we do this? Well, first, the directors will use stock dividends to keep the market price of the stock affordable. So when a corporation has a stock dividend, it increases the number of outstanding shares and it lowers the per share stock price. Another reason is that it shows management's confidence that the company is doing well and will continue to do well. So A stock dividend basically transfers part of retained earnings to the contributed capital accounts, sometimes described as capitalizing retained earnings. And so accounting for stock dividends differs depending upon whether it's considered a small or a large stock dividend. Okay. Let's look at some examples. So if Quest has 10,000 shares of $1 par value common stock outstanding, on December 31st, they're going to declare a 10% stock dividend when it was selling for $15 per share, and the stock will be distributed on January 20th. So the way that we record this entry is we take the 10,000 shares that are currently outstanding, and we multiply that by 10%. So they're going to issue another 1,000 shares of stock at the $15 selling price per share. So we're going to reduce our retained earnings by $15,000. We're going to increase our common stock dividend distributable. That's our liability account, which is going to be equal to the 1,000 shares times the $10 par value. So $10,000, and then we're going to have paid-in capital in excess of par for $5,000, the difference between the dividends that are going to be distributed, the 1,000 shares times $15 per share, and the 10,000 par value. Okay. So before the stock dividend, if you look at the top, we had common stock, $10 par, 15,000 shares authorized, 10,000 issued and outstanding. So we had $100,000 in our common stock account. We had paid-in capital in excess of par of $8,000, and we had retained earnings of $35,000 for a total of $143,000. Our journal entry to record the stock dividend reduced our retained earnings by $15,000. It increased our common stock dividend distributable by $10,000, and it increased our paid-in capital by $5,000. So if you look down below after the stock dividend, we increased our common stock by $110,000. We increased our paid-in capital to $13,000, and we reduced our retained earnings to $20,000. But our total stockholder equity didn't change because you're just moving it. Where's my highlighter? You're just moving it from, good grief, what is going on? From you're increasing your common stock and your paid-in capital, and you're reducing your retained earnings. Okay. All right, so recording a small stock dividend, let's talk about the date of distribution. So we recorded that entry and we put a common stock dividend distributable on our books. Well, on January 20th, when they actually distribute that stock, we're going to reduce our common stock dividend distributable with a debit of $10,000, and we're going to increase our common stock at that date by $10,000 for the par value. So this is no different than if you're paying a cash dividend. It's just rather than your credit being to cash, your credit's going to go to common stock the date that you distribute it. Okay? All right, so recording the large stock dividend. So Quest has 10,000 shares of $1 par value stock outstanding. Now, instead of 10% stock dividend, they're declaring a 30%, and it's going to be distributed on January 20th. So to compute the amount of the stock dividend, we're going to take our 10,000 shares times 30%. So we're going to issue another 3,000 shares. We have a par value of $10. So that's going to be a $30,000 reduction to retained earnings. And we're going to record a common stock dividend distributable liability account for $30,000. All right, so stock splits. So stock splits are basically a distribution of additional shares of stock to stockholders according to their ownership percentage. So let's say that we had $20 par value common stock, and we had $100,000 issued and outstanding. If they do a stock split, it's going to cut the par value in half, and it's going to double the number of shares. So let's look at some examples. So a company began the current year with the following balances in stockholder equity. All the outstanding common stock is issued for $15 per share when the company is created. Prepare the journal entries for the following transactions. So on January 10th, the board declared a 10-cent cash dividend per share to shareholders of record on January 28th. So we've got 200 shares issued and outstanding, and they're declaring a 10-cent. So on January 10th, oh, that's nice. They all come up at the same time. On January 10th, we're going to record our cash common dividend payable for our cash dividend that's declared. So we have retained earnings, reduction equal to the 200 shares times the 10 cents per share. So we have a reduction in retained earnings for $20. And we have to record our liability at the date of declaration. So that's a common dividend payable equal to 200 shares times 10 cents per share for $20. On the 28th, there's no entry required. On the 15th, they pay that dividend, so we're going to reduce our common dividend payable, $20, and we're going to reduce our cash, $20. Then on March 31st, they declare a 20% stock dividend. That's less than 25, so it's considered a small stock dividend. So small stock dividend, we're going to record our reduction to retained earnings equal to the number of shares that are currently issued and outstanding times 20%, because that's the stock dividend. So we're going to issue 40 shares, and we're going to issue those at the market price of $18 per share. So our reduction in retained earnings is going to be equal to $720. But our common stock dividend distributable liability account is going to be equal to the par value. So that's the 40,000 shares, or 40 shares times your $10 par. And then you have paid in capital in excess of par of $320. Then on May 1st, when you pay it, you're going to get rid of this liability here of $400. So we're going to debit our common stock dividend distributable. And at that point, we're going to recognize the increase in our common stock with a credit of $400. Okay. Then on May 1st, when we distribute same entry there. So on December 1st, when we declare a 40% stock dividend, that's considered to be a large stock dividend. So when we do that, we're going to reduce our retained earnings, 240 shares times the 40%. Remember, we started at 200 shares, but then we declared a small stock dividend, which gave us 40 additional shares. So we have 240 shares issued and outstanding now, times the 40% stock dividend. So we're going to issue another 96 shares, and we're going to do it at our $10 par. So we have a reduction in retained earnings of $960, and we're going to have a common stock dividend distributable liability account created at the date of declaration for $960. Then on December 31st, when we distribute the stock, we reduce our liability, and at that point, we increase our common stock on our balance sheet for the $10 par for $960. Okay. All right, so explaining the characteristics and the differences between common and preferred stock. So preferred stock has special rights that give it priority or senior status over common stock in one or more areas. So typically, it's like a preference for receiving dividends and assets and liquidation. Preferred stock has all the rights of common stock unless the corporate charter nullifies them. So most preferred stock, for instance, doesn't confer the right to vote. But they typically have priority over common shares in the distribution of dividends and distribution of assets. Okay. All right, so preferred stock usually carries a preference for dividends, meaning that they're allocated their dividends before any dividends are allocated to common shareholders. So the dividends allocated to preferred shareholders are usually expressed in a dollar amount per share or a percentage applied to par. So the preference, important thing to know is that a preference for dividends does not ensure dividends. So if the directors decide not to declare a dividend, nobody's going to receive one, right? So most preferred stocks give them cumulative dividend rights. So they get to be paid both current and all prior unpaid dividends before any dividends paid to a common stockholder. So when preferred stock is cumulative, and the directors do not declare a dividend to preferred shareholders, or they declare one that doesn't cover the total amount of the cumulative dividend, the unpaid dividend amount is called dividend in arrears. And so the accumulation of those dividends in arrears on preferred stock will get paid before, well, it doesn't guarantee, but if the money is available, they will get paid before common stockholders. So non-cumulative preferred stock offers no right to prior unpaid dividends if they weren't declared in those periods. So okay, so in this slide, they're trying to illustrate how the preferences work for preferred and common stock. And so the facts they give us are that the dividends declared in 17 are $5,000, and that in 18 they declare and pay dividends of $42,000. And on the left side, we've got the example of if the preferred stock is cumulative, and on the right side we have the example, the same example, but what happens if it's non-cumulative. So here's how this would work. So if the preferred stock is cumulative and they declare a $5,000 cash dividend in 17, that's going to go to your preferred stockholders. And then in 18, they tell us they have $4,000 in arrears and that they're going to pay $9,000 to the preferred stockholders for the current year dividend. So we've got $5,000 for 17. We have a total of $13,000 for 18. So of that $42,000 that they pay in 18, $18,000 of it is going to go to our preferred stockholders. So 42,000 minus 18, the rest is going to go to our common stockholders. Okay? If the stock is non-cumulative, the only difference is that 4,000 in arrears doesn't get paid. So the preferred stockholders are still going to get the 5,000. They're still going to get the 9,000 that's allocated to them in 18. And the net is going to go to the common for 33. Okay? All right, so we have this idea of participating preferred stock and non-participating preferred stock. So under participating, dividends may exceed a stated amount once the common stockholders receive dividends equal to the preferred rate. Non-participating means the dividends are limited to a maximum amount each year, and it's usually the stated dividend rate. Okay? So the reasons that we issue preferred stock is we could raise money without sacrificing control. Boost the return earned by common stockholders through financial leverage, and to appeal to investors who may believe common stock's too risky or that the expected return is too low. Okay? Read more about that in the book. All right, so a company's outstanding stock consists of 80 shares of non-cumulative 5% preferred stock with $5 par value, and also 200 shares of common stock with $1 par value. During its first 3 years of operation, the corporation declared and paid the following total cash dividends. So in part 1, they want us to determine the amount of dividends paid each year to the two classes of stockholders, and then to compute the total dividends paid to each class for the 3 years. So our annual preferred dividend is going to be equal to the $5 preferred par value per share times, they tell us they have a 5% dividend. So our dividend per preferred share is 25 cents. We have 80 shares. So our annual preferred dividend is $20. And it's non-cumulative. So in year 1, We paid a total dividends of $15. Well, if our annual preferred dividend is 20, all 15 of that's going to go to our preferred. Our common stockholders aren't going to get anything. Then in year 2, if we paid $5, again, all of it's going to go to our preferred. Preferred stockholders are paid first, and we have nothing left to pay our common. And then in year 3, we paid $200. So 20 is the annual preferred dividend that we calculated here, right? So $20 is going to go to our preferred stockholders, and the other $180 is going to go to our common stockholders. Okay? All right, so part 2, determine the amount of dividends paid each year to the two classes of stockholders, assuming that the preferred stock is cumulative now, right? So if we paid $15 to our preferred stockholders in year 1, we're supposed to pay them $20. We have $5 in arrears. In year 2, we paid $5. So we gave all $5 to the preferred stockholders, but we still have $20 in arrear, right? Because we should be paying them $20 each year. So we paid them only $15 in year 1, so we had $5 in arrears. We paid $5 in year 2, so effectively we paid the arrears, but we didn't pay any of the $20 for year 2, so we have $20 in arrears. And then in year 3, we paid $200, so we're going to pay them both the $20 in arrears plus the $20 for the current year. And then we're going to pay the other $160 to the common stockholders. Okay? All right, so recording purchases and sales of treasury stock. So sometimes corporations buy back their own shares of stock for several reasons, either to acquire another corporation, avoid a hostile takeover, give them to employees as compensation, or to maintain a strong market. So when we purchase treasury stock is a contra equity account. And so for the example here, if we purchase 1,000 shares of our own stock back on the open market for $11.50, we are going to record a common stock treasury account debit, which this is a contra equity account, equal to the 1,000 shares times $11.50 per share. And we're going to reduce our cash with a credit of $11,500. Excuse me. All right, so selling treasury stock at cost. So if we turn around and we resell that treasury stock that we bought back, let's say we sold 100 shares, we're going to credit cash, or debit cash, sorry, for the 100 shares times $11.50 per share. And we're going to credit or increase, or reduce, our treasury stock common account by $1,150. So we had $11,500 in our treasury stock common account as a debit when we purchased back those shares. To reduce that, we're going to credit for the amount, the 100 of the 1,000 that we purchased back. We turned around and sold 100 of those. So to reduce our treasury stock common account, we credit because it's a contra equity account. Well, let's say we sell treasury stock above cost. So the previous slide, we sold it at cost. If we sell it above cost, so we sold an additional 400 shares, but this time we sold it for $12 when we purchased it back for $11.50. So we sold it above our cost to buy it back. So our cash that we're going to receive is going to be $400 times 12 bucks. So we'll debit cash for $4,800. But our credit to treasury stock common needs to be for the amount that we purchased it back for. So that needs to be at the $11.50. And then we have paid in capital treasury stock in excess of the cost that we had to buy it back. 50 cents times 400 shares, or $200. Okay. Okay, so what happens if we sell treasury stock below our cost? So on July 10th, Cyber sold an additional 500 shares of its treasury stock, but instead they sold it for $10 per share, where we had purchased it at $11.50, if you remember. So we're going to debit our cash for the 5,000 shares times $10, right? We will reduce our paid-in capital. Well, let's back up. We're going to reduce our treasury stock common equal to the 500 shares times 11.50 per share, because that was our cost. And then we need to reduce our paid-in capital for the difference. But the problem with this one is that our paid-in capital, if we were following all of our debits and credits, we can't reduce our paid-in capital below what the actual balance is that we have to reduce it by. So if we were to be using a T account for our paid-in capital treasury stock, we can't reduce it any further than the balance that we have. And all we had was $200. So we're going to debit our paid-in capital treasury stock account to take it to zero by $200. And then the difference is just going to be a reduction in retained earnings. Okay, so here's your $7.50, right? Your cost was $11.50 per share, but you sold it for $10, so you have a difference of $7.50 that you have to put somewhere. And typically it would all go to your paid-in capital treasury stock account, but you don't have enough money there because all we had was a credit balance of $200. So we can only reduce it by $200, and so the difference just goes to your retained earnings. Okay. All right, so company began the current year with the following balances in their stockholder equity accounts. And then they list the journal entries that they'd like us to record. So on July 1st, we purchased 30 shares of treasury stock at $20 per share. So our journal entry on July 1st is going to be a debit to our treasury stock account because it's a contra account. 30 shares times the $20 cost, debit of $600, and then we're going to reduce our cash with a credit of $600. Then on September 1st, we sold 20 of those treasury shares at $26 per share. So we sold them above the cost. So we have $20 times 26 bucks. We're going to get cash of $520. Our treasury stock account gets reduced only by the par or by the cost. So the stock that we sold, we had a cost of 20 bucks per share. So $20 times 20 shares is $400. And then the difference between the cost and what we sold it for, the $6 per share, times the 20 shares, gets recorded to our paid-in capital account, 120 bucks. Okay. Then on December 1st, we sold the remaining 10 shares of our treasury stock at $7 per share. Well, we sold it below the cost that it was to us, right? So we're going to get $10 per share times 7 bucks. We're going to reduce our treasury stock by $200. That's our 10 shares times our $20 cost. We only have $120 available in our paid-in capital account, so we'll reduce that to zero with a debit of $120 to our paid-in capital treasury stock, and then the difference gets recorded to our retained earnings account. Okay? All right, so explain the items reported in retained earnings. All right, so retained earnings, we've said a couple times, I think, that is basically the accumulation of all the net income or net loss, less any dividends, since the company has started operating. So there's this idea of restricted retained earnings. So there's a legal restriction and a contractual restriction. So most states will restrict the amount of treasury stock purchases that are allowed to be taken from the amount of retained earnings. And then the contractual restriction is a lot of loan agreements can restrict paying dividends below a certain amount of retained earnings. All right, so the only thing that I think we hadn't talked about when we were preparing our statement of retained earnings was this idea of prior period adjustments. So sometimes mistakes happen, right? And so there's this idea of prior period adjustments, and what those are corrections of the material errors of past financial statements that result in a change in the balance, the beginning balance of retained earnings. So sometimes on your statement of retained earnings, you'll see this category called prior period adjustments, and there'll be a list of whatever it is that is being corrected to your beginning retained earnings balance. Okay, so when we started the class and throughout the class, we've talked about the 4 primary financial statements: the balance sheet, the income statement, the statement of cash flow, and the statement of retained earnings. Sometimes what you'll have instead of a statement of retained earnings is the statement of stockholders' equity. And it's really just a more comprehensive, I guess, way of presenting some of the same information as what a statement of retained earnings has. And so sometimes you'll see this instead. And so what this is it'll tell you the change in the various components of equity in a more detailed format. So you'll have your common stock, uh, your retained earnings, your accumulated other, and then total equity. And it'll take each of those sections and it'll break it down into the beginning balance, plus or minus all of the activity that then gets you to the ending balance. Okay. All right, so compute earnings per share and describe its use. So there's another ratio that's rather important and used quite frequently, and it's called the earnings per share. And so it's one of the most widely cited accounting statistics, and it's computed as follows. So we've got net income less preferred dividends divided by the weighted average common shares outstanding. That's going to give you your earnings per share. And then the price earnings ratio. So a comparison of the company's earnings per share and its market value per share reveals information about market expectations. So its comparison is traditionally made using the price earnings ratio, or what we call the PE ratio. And that's the market value or the price per share divided by the earnings per share. So some analysts interpret this ratio is the price that the market's willing to pay for the company's current earnings stream. All right, and then lastly, the dividend yield. So the dividend yield will tell us the amount of annual cash dividends distributed to common stockholders relative to its market price. So it's the annual cash dividends per share divided by the market value per share. So uh, one way to help identify whether a stock is an income stock or a growth stock is to analyze its dividend yield. So it's yeah, and it's just the annual cash dividend divided by market value. All right, and then the book value per share. So book value per share reflects the amount of stockholders' equity applicable to common shares on a per share basis. So book value per share is the common stock or stockholders' equity applicable to common shares divided by the number of common shares outstanding. So in this case, if the common stock applicable to common shares is 333,000 and there's 10,000 shares, your book value per share is $33.30. All right, guys, that's the end of chapter 11. I hope you found this to be helpful. If you have any questions, as always, please don't hesitate to reach out. Thank you much.